Hello everyone, my name is Ashutosh Kar. I'm a chartered accountant, certified public accountant from USA with a PhD in commerce. I've started this YouTube channel to post videos relating to US taxation for both individuals and for businesses. To start with, we'll be posting videos relating to US taxation for businesses. So without any further delay, let's start the video.
Today's video is about property exchanged for stock. It is covered under IRC Section 351 exchange. So let's understand what is it and how it works. The transfer of property to a corporation in exchange for stock in that corporation is usually not taxable if immediately afterward the taxpayer is in control of the corporation. To be in control of corporation, the transferor must own at least 80% of the total combined voting power of all the classes of stock and at least 80% of the outstanding shares of each class of the non-voting stocks immediately after the exchange. So this type of non-taxable applies both to individuals and to groups who transfer the property to a corporation. Both the corporation and any person involved in a non-taxable exchange of property for stock must attach to their income tax return a complete statement of all the facts pertinent to the exchange. So now let's understand this with an example. Let's say A and B buy the property for $100,000 and both organizes a corporation when the property has a fair market value of $300,000. Now A transfers the property to the corporation for all its authorized capital stock, which has a par value of $300,000. So in this case, no gain is recognized either by A or B or the corporation. Now let's take another example. A and B both buy the property worth $100,000 and A and B transfer the property with a value of $100,000 to a corporation in exchange for a stock with a fair market value of $300,000. And this represents only 75% of each class of stock of the corporation, wherein 25% was already issued to someone else. In this case, both A and B has to recognize a taxable gain of $200,000 on this transaction. So the term property doesn't include services rendered to the issuing corporation. So the value of stock received for services is income to the recipient. It means if a shareholder performs services in exchange for stock, the control requirement of 351 can be lost. Only the shares attributed to the exchange of property count towards the control requirement. So now let's understand this with an example. A transfers property worth $30,000 and renders service valued $5,000 to a corporation in exchange for a stock valued at $35,000. Right after exchange, A owns 85% of his outstanding stock. In this case, no gain is recognized on the exchange of the property. However, A has to recognize ordinary income of $5,000 as a payment for service rendered to the corporation. In the subsequent video, we will understand and discuss different other provisions with respect to property exchange for stock. Thank you.